A corporate facility expansion locks an organization into a geography for 20 years. It's an irreversible commitment of heavy capital, jobs, and intensive focus. When executive teams evaluate potential locations for this kind of growth, they typically rely on spreadsheets. They compare municipalities line by line, looking for the cheapest available land and the highest upfront tax incentives. But those spreadsheets omit the physical realities of breaking ground. They account for the purchase price, but ignore the operational friction of getting the facility built, staffed, and running. This is the ground reality. Cheap land frequently comes with hidden operational bottlenecks. Construction schedules stall waiting for clearances. Equipment orders get delayed by infrastructure, and the applicant pool is empty. Prioritizing flashy upfront cost savings without investigating a region's actual operational readiness introduces massive, unquantifiable risk to the entire expansion timeline. Many municipalities run marketing campaigns calling themselves business-friendly. A much smaller subset of regions have done the logistical work to demonstrate true structural readiness. You can cut through the public relations hype by looking for the 5 signals of readiness. This is a diagnostic framework that evaluates a location based on real-world operational viability. These 5 signals apply across the board. Whether you are leading a high-speed technology scale-up or a heavy manufacturing enterprise, these indicators determine if a region can support your operations. Finding these signals requires accepting a central trade-off. Your company must be willing to sacrifice maximum short-term cash incentives in exchange for long-term operational stability and reliable speed to market. Verifying these 5 structural elements is the only reliable method for an executive team to minimize the risk of a stalled multi-million-dollar expansion. Expansion decisions require momentum. When timelines become uncertain, the entire project degrades. Financing stalls, contractors hesitate to commit resources, and workforce hiring phases are delayed indefinitely. Signal 1 is clear and predictable approval timelines. A ready region provides a structured permitting pathway with coordinated agencies, ensuring final approvals within a strict 60 to 90-day window. The trade-off for Signal 1 means walking away from cheaper municipalities. You accept a higher baseline cost to bypass local zoning boards that lack the sophistication to process rapid, reliable approvals. But speed also dictates your physical requirements. There is a hard distinction between available raw land and a site that is truly prepared for construction. This dual timeline compares site types. The top raw land bar is bogged down by delays. The bottom shows Signal 2, a shovel-ready site with pre-installed utilities and clearances. Securing this requires a premium to avoid burning capital and time on basic ground preparation. Securing these structured timelines and verified infrastructure allows leadership to align their construction schedules exactly with their financing and revenue generation targets. Once the facility is built, the financial team assumes control. They require an accurate 10 to 20-year operational cost forecast to maintain profitability. This 10-year forecast compares 2 models. The jagged line shows one-off cash grants, causing unpredictable costs. The flat line represents Signal 3, transparent, multi-year tax agreements. This stability allows financial officers to accurately model taxes, forecast baseline costs, and plan investments over 2 decades. The trade-off for Signal 3 is public perception.
Leadership must be willing to forfeit the immediate PR boost of a massive short-term cash injection in order to secure strict, long-term fiscal predictability. Reducing financial uncertainty over a 20-year period gives boards the data they need to authorize larger, more ambitious capital investments. The greatest operational vulnerability in any expansion occurs immediately after construction finishes, staffing the facility and sustaining that workforce over time. Signal 4 is a defined workforce strategy. You are looking for regions with active, established partnerships between local training institutions and the specific industries they target. Standard location analysis relies on the stagnant snapshot of current unemployment statistics. An adaptable labor pool pipeline actively trains new talent to meet your specific technological needs as they evolve. Achieving Signal 4 requires your company to invest its own time and resources. You must transition from a passive hire into an active community partner, directly collaborating with local education boards to shape curriculum. The final phase of an expansion is ongoing operations.
The risk here is that local authorities and economic development teams disappear entirely the moment the ribbon is cut. Signal number 5 is true continuous engagement. Strong local economic development teams remain active partners, helping your company streamline future expansion phases and access ongoing state-level programs. The trade-off for Signal 5 is transparency. You must maintain an open-book relationship with local authorities, treating them as permanent operational partners rather than adversaries to be out-negotiated for a tax break. Regions demonstrating Signals 4 and 5 view economic development as a continuous process. This ensures your facility remains viable, supported, and fully staffed over time. This chart shows a 4-quadrant matrix to help leadership teams weigh these signals against their risk tolerances. If your company is a speed-to-market scale-up, you operate with low tolerance for delay and a high need for stability. This profile must ruthlessly prioritize Signals 1 and 2, predictable timelines, and shovel-ready infrastructure. If the permitting schedule is vague, you must walk away from the cheap land. If your company fits the long-term enterprise profile, your focus is on a long planning horizon and ironclad operational stability. This segment must heavily weight Signals 3 and 4, financial modeling and active workforce pipelines, to prevent devastating labor shortages 10 years into operations. Bootstrap startups often fit the incentive chaser profile, mapped here in the quadrant representing high risk tolerance. The hidden cost for incentive chasers is severe. Choosing the absolute cheapest land means your organization will likely absorb the cost of building the infrastructure and training the workforce completely on your own. Aligning your specific expansion profile with the correct regional signals transforms a facility build from a high-risk gamble into highly predictable progress. A truly prepared region changes the economics of an expansion, moving a company smoothly from planning to building to growing. When evaluating locations, the executive mandate must shift. Stop asking, "What will they give us?" and start asking, "How ready are they for us?" Organizations like the Fulton County IDA, an industrial development agency in New York, serve as a benchmark for this approach, prioritizing upfront structural readiness and continuous operational support over empty marketing. When infrastructure, structured timelines, and long-term partnerships align, an expansion serves as the secure foundation for lasting corporate success.